It's a bad joke. Dropped at the first sign of trouble. They're only as good as the world allows them to be. I'll show you. When the chips are down, these civilized people, they'll eat each other. See, I'm not a monster. I'm just ahead of the curve.
What is going on YouTube? It's Brendan from Market Makers. Guys, I have a special video for you today. They want you poor. I'm going to explain to you before we get into the TA and the charts. The CPI inflation number dropped today. I want to explain to you the relationship this has with the economy, this has with Wall Street, and this has with the politicians, because they are all lying to you about the health and welfare, the strength of the economy. It's a paper tiger. So let's go ahead and jump right into this. 3.4% on the CPI headline. This is up 0.3% on top of what they already thought would be slightly hotter inflation. We have the market having a negative reaction. But is that the actual inflation number for the US? And guys, everything I'm about to say relates directly to the ECB, the Eurozone, all the Western economies in general is full of bullshit, lies, and stories. I want to give you some of the truths about the US economy in this video. So at 3.4%, Lee, give me the Truflation report. Truflation, guys, you can check out the website. This is an aggregate amount of inflation, 22%. So to put this in perspective for you, inflation is compounding. A family of four, let's say with an income of $100,000 a year, they're actually living off of $80,000 a year. When you go to the grocery store, you don't see 3% inflation because inflation is compounding. Everything you buy has much higher prices than just 2, 3, 4 years ago. What the Fed is trying to do is slow the rate of growth. I had a friend call me the other day and say, hey, inflation's down pretty good now, right? 3%. Is it, guys? No, because that's the rate of change. Most Americans do not understand this. Media doesn't understand this. And if they do, then they lie to you and tell you, well, inflation's really good right now. 2/3 of Americans live paycheck to paycheck. Ask them how they're doing. The jobs reports that come out, the last job report that came out, we added 200,000 jobs. Again, bullshit number. Why is that a bullshit number? 11 of the 12 jobs reports last year in 2023 were revised down, almost 500,000 jobs. The majority of the jobs on these jobs reports are government jobs. These are government jobs. What does that mean? There's two different types of jobs. There's jobs that produce things. Think about making something, iPhones, working for a business, you're creating products. And then there's government jobs, which are nothing more than an economic suck, right? The government doesn't produce anything to be self-sustaining. It relies on taxing people to fund its employees. So these are government jobs. Part of the reason we're running a 6 to 7% deficit right now, which is unheard of outside of war. But also understand the household survey is much more accurate than the non-farm payroll report that the Fed relies on. The non-farm payrolls only has about a 40% response rate from the big businesses that they solicit. Household report says we've lost 1 million full-time jobs. A record number of 8 million Americans are now working 2 jobs. Why? Is that because inflation's 3%? So they want to work a second job? No, it's because they're trying to make ends meet. So what's the big Ponzi here? What is the big scheme? Why does the government, why does the Fed care so much about holding up and propping up the US stock market? Why is that so important? Well, Lee, show them the article from Axios. A record 93% of all US equities are held by the top 10% of Americans. These are the wealthiest people, including politicians, in the country. They hold more than 9/10 of all the equity. So a lot of you think, well, I have a 401k, I have some stocks in there. You own such a nothing compared to the top 10% of the country. This is all about protecting Wall Street. This is all about protecting who? The donor class who gives the money, who works hand in hand with the corrupt government to secure the wealth of the nation. This is why, by the way, this is why that we had these incremental increases by Fed Chair Powell to fight inflation. I want to juxtapose this with you. Back when I was 4 or 5 years old, we had Volcker in, we had Reagan in the early 80s. We had 13% inflation. Now, Fed Chair Powell likes to compare himself to Volcker all the time. Remember that back in 2022, he says he has Volcker's book sitting on his desk and he'll do what's necessary to fight inflation. Volcker jacked up rates to 20% when we had 13% inflation. And you could say, but Brendan, we only got to 8.9, let's call it 9% inflation in the US, and Powell went up to 5.25 on the Fed funds rate. That's kind of the same thing. No, it's not at all. Larry Summers, who's a Treasury Secretary under Bill Clinton, also former head of Harvard, also an economist, took the way that we measure, because remember, they tinker with, it's called hedonics. They constantly changed how the CPI is measured. Larry Summers took our CPI, the way we measure it, and applied it to all the economic indicators back in the early 80s. You know what number he came up with? 9.1%. So back then it was calculated at 13%. Larry Summers came up with the way that we measure it now, applied it to the early 1980s, 9.1%, and Volcker took rates to 20%. By the way, Volcker caused 2 stock market crashes, 2 recessions when he did that, but you got a 40-year bull run out of that. Now, what was the result of that, by the way? How did the American people take that? Well, when Ronald Reagan ran for re-election, he won 49 of 50 states. That's called being a populist and protecting the people. That's what you want to do. What we have now is this Operation Election Protection, Wealth Protection, under Fed Chair Powell, under Biden. By going up to only 5%, what you've caused is this aggregate buildup of inflation the last few years where everything costs more money and the average person is getting decimated. This is a really important concept to understand because most people don't understand that. You do not have deflation. There is no catalyst for the prices of things to drop, only to continually go up. And if you listen to these idiots on YouTube who talk about economics and say, well, you don't want deflation, you want inflation. This is the best thing for the economy. Really? How long has that been a policy of the US government? Most people don't even know. How long has it been a policy of the US government to have this 2% inflation target? Does anybody know? 2012, Ben Bernanke. Do you know where he got that idea from? The New Zealand Central Bank, who a few years earlier said, we will never allow inflation to go above 2%. That was their watermark target, right? Their ceiling. We're not going to go above 2%. Bernanke adopted it in 2012. Guys, that was 11 years ago. Okay, this has not been a long-standing policy to constantly have inflation. It was 11 years ago, and look what it has done. Back in the GFC, we had $6 or $7 trillion in debt. Back with Ronald Reagan, we had $1 trillion in debt. In the 90s, we ran a surplus. And since the GFC, we now have $34 trillion in debt. And what does that mean? We have to service the debt. So eventually they're going to be cutting government programs, including Social Security. It's a mathematical thing. They're going to have to do it. And raising taxes. Why? So we could have a 2% inflation target and constantly print money. Over the last quarter of 2023, the Biden administration added $1 trillion in debt in 3 months. Absolutely insane. $1 trillion in debt. Now we have $34 trillion in debt. Guys, this is a huge disaster on the economy. But what I want to talk about and tie this as well, you have to understand this nature of politics and how it ties into Wall Street. Most of these politicians, a lot of these politicians, right, outside of the insider trading that they do, we all know the best trader is not on Wall Street. It's in Washington, D.C. That was Nancy Pelosi, right? But outside of that corruption where they can actually trade, knowing what laws they're going to pass, knowing how it affect the U.S. economy, we also know that a lot of these politicians, congressmen, senators, ex-people in power, ex-people in the cabinet, what do? They take these advisory positions on Wall Street and they get paid millions and millions of dollars to do what? To lobby. So everything the Fed does, everything the government does, and everything Wall Street does is for the protection of Wall Street, the protection of the wealthiest people in the world, guys. It's a sick game. That's why trading can help you find financial freedom, but you have to understand how the game is played. And the way this game is played, you have to be able to hold two thoughts in your mind at the exact same time. You have to understand the reality of the economy. We're going to go over the indicators here in a second, but also understand the detachment of the stock market, because the stock market is a Ponzi scheme, as Scott Minerd said. The prices you pay for things do not reflect the actual value of a company. When Tesla was trading at a 400 PE, 400 PE. That was not the actual value of the company. That's FOMO. That's just future price and earnings. But to put this in perspective for the average person, if you have a house, right? You have a house. Let's use easy numbers. You have a house, let's say it's worth $1 million and it's been gaining whatever, 20% a year since we had this whole pandemic thing, right? So 20% a year. Would you go to a person who has $1 million house gaining 20% a year? You can correlate this with a company, right? And say, you know what? I'll pay you a 40 multiple on that. I'll give you $40 million for your $1 million house. No, nobody would ever do that. Happens every day in the stock market. Look at NVIDIA. Look at Apple. Apple declining sales, quarter over quarter, finally 2 downgrades, and Apple still rallied a lot this past year. What was it, 50% up it rallied? So you have to understand how the market works. You got to be able to hold two ideas at the same time, and most people can't, right? Most people are NPCs, and I'm including mainstream media, including some people with big money. I told you there's no smart money in this market. It's big dumb money and small dumb money. But you got to be able to hold these two ideas and understand reality. Lee, let's show them some reality. Guys, first I want to show you LEI. We've talked about this before, leading economic indicator index. On YouTube, this guy, EPB Research, you can watch his video. Great video he did. It's about 6.5 minutes long. I'm going to show you like a 30-40 second clip here on the LEI. Lee, go ahead and roll this. I'll talk to you guys about it on the other side.
According to the Conference Board, when the 6-month growth rate of the Conference Board leading index drops below negative 4.5%, a recession signal is triggered. There were a few times when the Conference Board leading index fell into negative territory, like in 1967, 1995, 1998, and 2016, but not sufficiently below the negative 4.5% threshold. There has not been one instance where that negative 4.5% recession threshold was breached when the economic cycle did not conclude in a hard landing.
So that's the LEI index, guys. Not one false signal ever since they started keeping track of the data in the early 1960s. You need to understand this because the LEI doesn't tell you when you're getting a recession, but it tells you you're getting a recession. And all through 2023, we hovered at -8% on the LEI, well into the recession territory, which is why I think we are already in a recession, but the market won't realize it until it's too late. Again, walking up to that Q1 peak, rallying right into the recession, just like we did in the GFC. Speaking of which, the GFC had 26 months negative in a row on the LEI. That's the current king. Right now, we're at 20. We are at -20 on the LEI, 20 months in a consecutive months in a row of negative prints on the LEI. If we get to the summer, we're going to match the GFC if everything hasn't totally cratered by then. So this is really important to understand. Now, what do markets typically do post yield curve inversion? You guys have all heard about the yield curve. We've talked about this many times over the last year or two here on the channel. When you have the yield curve inversion, it is a warning, a recessionary warning. We have a 100% inversion of the curve at the peak, the strongest and longest inversion in US history. Something very important to understand. Why is that important to understand? Because you get massive economic drawdowns when you have 100% inversions of the yield curve. So Lee, show them the chart. Let's just go and put the chart up. Pictures say more than words. So guys, this is the markets going back, what is that, the 1960s? Going back to show you every yield curve inversion, how the market plays out. Focus on the red line. That's the current market. We are rallying. We're going to rally just like we did in the GFC. Lee, show them the beige line. The beige line is the GFC. We rallied up into the recession and then fell apart. Guys, these are all very important things to understand how the market's going to play out, because the way that it looks like it will play out, if we go off the yield curve inversion in the GFC, see, the yield curve was inverted for 2 years. 2 years prior to feeling the full force of what's coming. And where are we now? The yield curve inverted in July of 2022. Again, if you get to the summer, that is again a 2-year inversion, right? So all you can do is look at historical lags to try to predict this, look at key pivot points in the marketplace, and understand how economic cycles work, how the business cycle works, because unemployment is not going to tell you what you need to know until it's too late. Lee, unemployment chart. Again, guys, when does unemployment spike up? Because that's all they talk about on business news. Unemployment spikes up. Look at the red lines. Those are the recessions. The black wave going up, that is unemployment. Unemployment spikes up after and during a recession. So when they start telling you, well, unemployment's really going up, guess what, Bob? It's too late. The market's crashing. So think about what people are telling you right now. Lee, throw this up from Tom Lee. Tom Lee right now for his 2024 prediction has Bitcoin at 100 to 150K. That's on CNBC. It's on YouTube. You can go watch the video. So he has 100 to 150K. Now, a key point in Tom Lee's, I don't know what you would call it, forecast would be that he doesn't expect a recession. Again, ignoring all of the 100% accuracy of all the recession indicators, ignoring all that, doesn't expect a recession. Bitcoin 100, 150K. Again, juxtapose that with Tom Lee in Q4 of 2021. Bitcoin 250K for 2022. And where did Bitcoin do? By the way, Q4 2021, you can go back and watch the videos. I had 10.5. Bitcoin went to 15.5, dropped 80%. Right? So who was closer? You have to understand, again, the Ponzi narrative, the Ponzi salesmen that come out. The whole market is propped up by people buying. And the way that you get these Minsky moments with price dropping 3 to 5 times faster than price will rise is when big dumb money starts dumping because they can move the markets and all retail piles in at the door. This is why forecasting economic cycles, understanding the history of how economic cycles work can help protect you to the upside and the downside, guys. That's what this whole game is about. Knowledge is power. Understand how this is working. Don't get involved in a bull camp or a bear camp. And you see these people, these are the low IQ people that leave comments with laughing emojis and things because they don't understand that you're going to have a recession. They don't understand that, oh, recession, people have been saying that for 2 years. Guys, it's going to happen. And when it happens, what's the average recessionary drawdown? Minus 33% from your all-time high. That's the average recessionary drawdown. I have the S&P going to 3,200, Bitcoin going to 11 to 13K. And guess what, guys? If something breaks in the market, whether it's in the debt market, whether it's bank failures, whatever it is, another catalyst like another war, terrorist attack, if something breaks in the marketplace, you have your historic bubble targets, which have happened twice in the last 20 years, minus 50% on the S&P. All these things you need to be aware of because if I'm correct, then this year in 2024, you're going to see that recession hit, the lag of the recession. You're going to see a stark sell-off, and I'm looking for that run-up going into Q1. So understand all these things, guys. We'll talk about them more on the channel. I wanted to cover this because most people have no idea what's going on with inflation or with the economy, and they look at the mainstream media and the Ponzi salespeople they send out there telling you what to buy. When in reality, by the way, if you bought the S&P and held it at the end of 2021, you're still down. You are still down. And a lot of people, especially my friends, own individual stocks. So if you own Tesla and got out when Tesla was $400, it doesn't matter that the stock market's just slightly off its all-time high. Where's Tesla right now? $230, almost cut in half. So keep that in perspective when you think about the value of things in the marketplace. Lee, let's go ahead and start the show. All right, guys, I hope you enjoyed my economic rant update. And if you did, please do like the video, subscribe to the channel, and check out our fantastic sponsors that help support this channel. If you do indeed want to trade these markets, SimpleFX will give you up to a $5,000 instant first-time deposit bonus exclusive to our link, as well as BingX, which is a great crypto exchange, will give you exclusive bonuses with our link. Both of those are pinned in the YouTube video description. I'll pin them in the YouTube comments as well. Lee's Telegram will be pinned in the YouTube comments if you have any questions. And both those exchanges will pay for your first month on our Discord if you care to join a freedom-seeking community. It's a lot of fun to be in our Discord, guys. 12,000 people are on the server. Let's go ahead and start off. Bitcoin. So this has been some accurate TA for Bitcoin, right? We had our diamond pattern breakout. I shared this trade with you on October 23rd. Now gave you a 54% win here off of this trade. You can go back on YouTube and watch that. And as well as we've been talking about now for weeks about the 618 from the all-time high, 48,562. What did you do? You got slightly above it. You got to 48,986. So you got a few $100s above it, came right back down. Key resistance level here for Bitcoin on the 3-day chart. Diamond breakout, hit the 618 from the all-time high. So now what, right? That's the key thing. Now what? First, let's look at our indicators on the 3-day chart. Still bullish. You do have some bearish divergence on the MFI, but you have bullish price action. And again, momentum still bullish, cooling off though. 3-day chart's going to be a little bit delayed. Let's go ahead and look at the daily. On the daily, the MFI is in the bullish territory, pushing up. Momentum in the bullish territory, pushing up. Let's look at how this actually portrays here. So when we look at this, guys, a couple of things. You saw me put Bitcoin in a mini cough structure here. We go to this mini cough structure. There's our buying climax. I'll walk you through this here. So buying climax, there's your reaction. And again, I'm actually surprised Bitcoin is doing how it should behave with a mini cough structure, the price action, I mean. You have your buying climax, you have your reaction, you kind of retest the ceiling here, sign a weakness, retest the base. And what did you do? You got your up thrust, fell back down, held your higher low here, and then came up. But look what price is doing. It could be forming its Livermore pivot if it intends to stay bullish here, right? So what would that be? That is traditionally what you see in normal assets that are not hyper volatile. You'll see price go up and hit resistance, which it did at 48,562. It eventually may come back down, retest the ceiling at 44,515, and then you'll get some type of pattern that forms, whether it's a W pattern, to try to break that fractal and maybe go up to that 50K number to see if you can break that, right? So there's your fractal. You want to see if Bitcoin can do this type of move. That would be your Livermore pivot, taking out that fractal high. Conversely, if the markets just chop around and get more bearish, you can do something like a 3-wave top where you end up re-entering your prior trading range. So let's look at this from a Fibonacci perspective of this current move. We'll take this last impulsive test here that's moved back up to the upside. You can see Bitcoin on the daily, it literally bounced right off of the 382, 45,672. So normal, healthy retracements, guys. You want to stay above the 618. You can test the 618, come back down. Like I said, maybe make a double bottom, chop around in here, or just start propelling yourself out to the upside. Now, if Bitcoin ends up moving with my forecast, which is for the markets to peak in March, April, right? I would expect more upside for Bitcoin. So we'll see how long we spend in this range. But again, this could be a choppy range with some volatility with the US equities going up and down in a range while they have to work off their overbought conditions. Or if we start seeing economic conditions change more rapidly, right? Or catalysts come from the outside, expanding wars, lots of different catalysts. You got to be adaptable in this marketplace. You can see bearish patterns form. Either way, we'll be making videos talking about it. But as of right now, you're holding the 382. The ETF news seems to have been a buy the rumors, sell the news event because you didn't really move up from the ETF news. You didn't move up a whole lot, but you are holding key structure here to be more bullish. And what you want to see is what happens in this range. Do you print a bearish pattern or a bullish pattern? It is too early to tell. Jump over to the S&P. Long-term subs will remember our 42, 43-day pivot bar pattern, 43 bars, 60, 61 days. How many times this played out for tradable moves? We traded them on the channel, of course, and in the Discord. Big moves in the marketplace, right? I want to show you this fractal pattern because this is something else that's repeating over here. This pattern popped up on YouTube after I made those videos showing this fractal pattern, but here you are at the base, right, of your corrective move in the S&P. Look at where the 43 days got you to once again. 43 days, that was the top of your 9-week rally. Look at that. The top of your rally, 43 days, then you got your little bit of a sell-off, right? So that's where this 43-day 43 bar, fractal pattern keeps repeating in the marketplace. Now let's talk about Fibonacci's. You guys have seen me measure Fibonacci several different ways. People asking me questions about them. I want to try to answer those really quickly. I take Fibonacci's from different perspectives to look for Fibonacci confluence, right? Because trading for me is all about confluence of the things. Confluence of indicators. Am I overbought, oversold? Am I at peak resistance? How many types of resistance do I have there? Do you have Fibonacci resistance, volume resistance, whatever, right? So from that corrective high to that corrective low, this is where I'm getting my 1618, the 4922 number, right? Again, Q1, March, April, looking for 4,900 to 5,000 in that range to be hit, 4,922 to 5,000. However, the Fibonacci that's tracking the best, right, is off of this market symmetry pattern here, this fractal pattern. Now, these actual wave movements are actually the same as well. So you have your 42 bars up, 42 bars down. And then look at the wave movements here off of this. So going up to that high here from August 2022, 19% move, up move. And what was your low? Symmetrical wave back down to the downside, 19% down move as well. So 19% up, 19% down. So that tells me I want to check this with the trend-based fib. Now, you may see Gareth Soloway do this in a few weeks after he does some research and watches my video to try to understand trend-based fibs. But let's go ahead and look at this trend-based fib. We'll go here, starting point, go to that rally high, go down to that rally low, and look how beautiful this fib is tracking. And the key thing when you're laying out fibs, you think you have a good pivot point, you think you have a good W pattern, M pattern, you want to check your fibs. How are they actually playing out, right? Because look at your 100% retracement. Beautiful, right? Beautiful hit, beautiful resistance, sell off. Again, resistance for a long time. This was prior to our breakout, the 100% retracement. And when you come up to these higher levels, this is the key point here, right? The golden ratio, 1618. So you had this trend-based fib in play, by the way, in play all the way since October 2022. Again, Fibonacci can give you awesome forecasts if you understand the harmonic expansion, harmonic contraction, the natural law method of trading in the marketplace, because you had that since October 2022. And that price, again, was not hit until July of 2023. And look at that. You didn't get a single close above the 4604, but you did get price moving to 4609, right? $5 up above it, made this double top, fell down, and this was the top of your retracement. By the way, and I've said this before, I posted a trade on our Discord that I took at this level, 45.92 to be specific, and that would have captured a 500 bar drop. Also shared on YouTube, the 43.82 trade, that gave you a 300 bar drop in that decline. So those are my two big trades in that decline. Now, when we look at this up move, how's the Fibonacci tracking? And it's tracking absolutely gorgeous. Look at this. Look how price is pinned between a 1 spot 732 and a 1 spot 902. This is where you're pinned and you're doing that coiling action. So I want to see what happens here. You know, I said we could have a shallow retracement. So far, that's how it's played out. Your deeper retracement would be down here. Okay, this would be your deeper retracement for the marketplace. Let me go ahead and throw a fib on that for you. Some impulsive move out up to that fractal high. This would be that 4,600 level. This is where S&P is in trouble, is if it can take out that 4,600 level. That's how you get to these deeper levels like the 1618 at 43.85, right? You could do that, but I think the price wants to be bullish. You know, Tom Lee has a forecast. You know, we showed that video screenshot there in the intro, but in the monologue, Tom Lee has a forecast. He thinks the first half of the year is weak, second half strong, but that's because Tom Lee doesn't think we're having a recession, okay? I think it's the exact opposite. The first few months of this year, that March, April peak, are going to be strong, and the back half's going to be weak because of the recession lag finally hitting the marketplace. So I think you're going to try to stay in the shallower retracement range. Your 46.82 is hit. So basically 46.50. Let's see if we coil up here and when we actually start to spring out. And when we do, if we do start to move out of here, 48.67 is a 200% retracement. Again, look how clean this is tracking. That's the next level I want to track. And that will be on our way back up. Okay. 48.67 57 would take you up to those higher levels of the 4,900, potentially 5,000 psychological level. That's all going to depend what type of pattern forms in here right now. Right now, you have a double top type pattern. We talked about this before, a three-wave pattern, but I think you're chopping around in here, and the market wants to remain bullish. And until it shows me something different, we worked off our overbought condition, coming slightly negative now in the MFI. Price is still holding up. Volatility momentum starting to baseline. Momentum baselining here on the daily. So I think you're in this coiling range. And I think you would need an outside catalyst to really start breaking down some really bad economic news, something to really scare the market, because the hotter inflation, it scared us off of 4,800 once again, right? Key resistance, 47.99, scared us off of 4,800, but you're right back at 47.77 here at 2:00 in the afternoon as I'm recording this video. So look for this chopping motion here, and maybe we do get something. What we could end up doing here is a W pattern like this, pull back to a level, maybe 47.50, 47.30, and then come back up to that side. Or we could just be coiling in here for a while, grinding for higher lows. We'll see how it plays out, guys. Let's go ahead and look at the NASDAQ. NASDAQ, same thing. I'm looking at our key 200% retracement here at 1718. You have the three-wave pattern, your double top forming here on the NASDAQ. You had some big moves up in NVIDIA the last couple of days. You look at your MFI on the 3-day chart, guys, it's still very bullish. Bounced right off the moving average, coming back up, could be making a double top pattern here on the 3-day on the MFI. Let's look at the 1-day on the MFI. 1 day, you're still in the bullish territory. You're not overbought yet. You got some more room to move up. So again, I want to see how the markets behave, because they all seem to want to hold these key levels. And we'll see if we start coiling here, getting volatility momentum. These are all tradable moves on smaller time frames, but 17K essentially is still a very strong resistance. Your key support level would be just below this, just at this pivot here, 16,135, which you didn't even come all the way down to. So we'll see. We'll see what happens. You can end up going up just like this, pulling back just like on the S&P, and that would be your W pattern. You see that? Your W pattern for a breakout to the upside, but this may take a little bit more time waving up and down here in early January. It's a holiday week next week, guys. Monday's market's closed, so it's a 4-day trading week. We could see the market just sit still here or start drifting up today and tomorrow as well. Looking at the baby S&P, the Dow, 37,799. I had posted a trade in here in the room, I guess, what was it, a week or so ago when we hit it. Price did fall all the way down to, let me expand this. Why is it so small? Price did fall all the way down to, where is that at? 37,239. So, 550 point move. Nothing tremendous. You came right back up again here. You're retesting 37,799. Again, keeping these shallow retracements in place right now. So you'd have to have something break one way or the other. Markets still want to hold up at these higher levels. Let's look at the MFI just below the median line, worked off the overbought condition. Momentum coming back down to neutral. But again, price is staying elevated, guys. So these are ranges you could chop around in. You can always do your Wyckoff trading ranges here off your buying climax, and then off of your reaction candle, and you're just chopping around in the high end of this range. So you want to see price break out one way or the other, or start moving down with this bearish 3-wave pattern and taking out that neckline. We'll see how it plays. I think price is going to chop and go sideways until they want to move up towards that peak. When could that lift off happen? We'll know when we start getting some more candles. The Russell is what everybody's bullish on the mainstream media. They love these small caps. Most of these companies, guys, zombie companies, 40% of them cannot pay. They cannot service their own, or they live off of finances. They live off of debt, okay? They don't make any money. 40% of the companies are zombie companies. Having some brain fog today. Just to give you an idea, guys, Apple by itself is worth more than the whole Russell 2000. So a lot of these are garbage companies. There's some good companies in here, but a lot of these are garbage companies. Well, 40% of them are garbage companies, but this is what they love. And I think if we get that peak coming in, you're going to do something here in the Russell and come to this 2146. I want to watch this because right now this is not a bullish pattern. This is a 3-wave pattern that's really not coming up that much and could end up being a double top. And you have to watch all these pivot levels where you could retrace to as well if the markets do start turning a little bit more bearish. So Russell, nothing to see here yet. You're at 1951. Interesting to see this if it gets closer to 2146, the 618. the 618 from the all-time high. Let's look at the DAX. Talking about Fibonacci, guys. You guys know this already. If you go to your March 28th, 2022, have had these fib levels forever, down to your October bottom, 1618, 169. I mean, again, beautiful hits on the DAX. You are just stacking candles side by side. The markets went down when the US markets went down. This moves in correlation and in confluence with the US market. So you can watch the DAX, watch the Paris market. It's all going to be tied to the US market. But right now, when you look at this, you're just hanging out and hovering in this area. Now, Europe is far more advanced. Most of my family lives in Germany, far more advanced into the recessionary cycle than we are. But again, this is detached from reality, right? This is price action talking about equities. So if the US markets do move up some, we could see the DAX attempt to move up, but your key resistance remains 16.9. I thought you were going to get there today. You didn't get there before the sell-off, and it started coming back down, but you're holding a very tight range here on the DAX, basically 16.5 up to the 16.9 range. So just watch and see what happens here. Your MFI is still bullish here on a 3-day chart. So let's check this on the daily. Look at the DAX on the daily. You came up to the moving average just above the median line. You're pulling back a little bit. Again, this could sell off a little bit more, wave back up. You're doing these sideways actions. Remember, in sideways markets, you're either going to be in accumulation or distribution. Could you be in distribution? You could. But again, if my forecast plays out correctly, and we do end up rallying into Q1, I would expect the DAX to at least get back up to the 16.9, maybe the 17.2 level, and start chopping around a little bit higher. We'll see what happens here. Just keep an eye on these levels. Not a lot to see here. Not a lot of level changes, very tight ranges and all these equities, okay? Paris market, same thing. You have this in Wyckoff. The DAX is also in Wyckoff, but you guys can do that yourself off these same levels. When you look at this, Paris market, go to your March 2022 high, down to your October low. 1618 gave fantastic trades here on the Paris market. This was one of my big shorts here at 75.75. Had somebody held that trade, or had I held that trade for 850 points, but in the biggest short possibly ever. But I didn't hold it that whole way down, but that was a huge trade. And the 75.75 right here as well, guys, is your 1618. You can see the Paris market struggling. You still have the beginning of a 3-wave pattern. It looks very much like the Russell. It's really having a hard time coming back up. So watch 75.75. You're holding this range on all the markets, with the US markets also floating right now. Okay, so this could be a little bit more advanced. Let's put this on the daily time frame. Daily time frame, that was a 3-day chart. If you look at the daily time frame, you have your up level here. I mean, that's a really messy double top, and now you're just kind of basing down here. Again, I'm really just thinking, and you can see the MFI coming down to oversold. So if you can hold the price levels, reset the oscillators, what's the next natural move for the pendulum, right? You swing one way, you swing the other, and then you swing back up. So this could end up being a nice macro double top, depending what happens here at a higher level or the 75.75 level again. I would just watch all these markets. I'm not necessarily eager to trade any of them until I see some clearly defined patterns to give me some higher probability trades. Let's look at NVIDIA. Fibonacci always plays well on certain assets. Again, searching for assets, you're not going to find exact hits on every single asset depending how you lay out the Fibonacci's. But check this out. This is NVIDIA, your first all-time high, November 18th, 2021, right? Go down to your market low. Key thing here is what? Your 1618. Look at the hit. Look at the hit on the 1618. Again, held as resistance here for these little smaller sell-offs, but held as nice resistance here from 493 all the way down to 392. $100 drop off that 1618 hit. So you had harmonic expansion. Okay, you had harmonic expansion, and that was off your low there from October of 2022. Now, could this repeat again? Well, let's look at this. So we have our Wyckoff trading range. Let's take our Fibonacci. Let's go to that fractal high here, down to that fractal low. 570 spot 86 is your 1618. You're at 548 right now. Let's see what happens if you get up to that 570 level. If you get a nice retracement off of it, build some type of pattern like a double top or a 5-wave pattern like a head and shoulders. But let's see what happens here around that 570 level. Or if you exceed it, because remember, these higher beta stocks can definitely move further and faster than their slower beta components, right? So watch this level. You're in this in-between level right now, 532 to 570. It's going to be interesting to see. And they have their earnings coming out soon as well. When is that earnings? That earnings is Give me the chart. February 21. So that's coming up. It's a few weeks away. But watch this level. So that's the level I'm watching on the NVIDIA 570. Now that we've had this nice breakout here from our trading range. You got the nice breakout, move up, watch 570. And let's look at Tesla. What's Tesla doing? So Tesla, again, symmetrical moves in the marketplace, guys. You look at Tesla, we've been talking about this a long time now. You have a 30%, 29% down move, 30% down move. Again, this is a wave, 3 waves to a bottom pattern that formed here. You have your peak 1, peak 2, this would be your peak 3, and these typically happen in laws of 3 waves. So wave 1 down, wave 2 down. If you get a 30% move off of this, then we're going to be looking at where Tesla can bottom at here. And let's look at this. We'll see. We have, first of all, we got to that 260 level for resistance we talked about for quite some time. 259.10, you got above it. You did not close above it, and now you're falling down, right? Let's get rid of that. Let's see where this can go down to. We're going to pull fib retracement down there. You're falling to the 618 at 221. You're currently at 227. If you break this 194, this is what you want to watch. So let's look at this wave here. Let's go ahead and grab this price range. If we do another symmetrical move of 30%, take you down to about 184-ish on this move down. And you're at 226 right now. If it completes this pattern, then you'd be rebounding again. So you want to see what happens again, because the U.S. markets overall are chopping around. Each stock can have its own story, obviously, and external catalysts that affect it. So I wouldn't necessarily expect this to be completing this move here, especially if the U.S. markets end up holding up, in which case you will be making this W pattern here and pivoting back out to the upside. Last one, gold. Gold sold off a little bit as well with the markets. Gold's still at 2020 is where gold's at. But again, you have this pattern that formed, your W pattern here. Seeing if we can get to the upside. My near-term upside targets, if this holds true, again, this bottom keeps changing when gold goes down, guys. But 2134, $2,134. If we get the next push up with the March-April peak with the markets, gold will follow. That's where I think it's going, 2134.99. Then we should have some topping action. Guys, hope you enjoyed the elongated video today. Have a fantastic weekend. Drop me a comment. Be happy to reply. Take care, everybody.